That's nice. Thank you for the introduction. It's always nice to be introduced, even though I'm just introducing somebody. I appreciate that. I think from our perspective, one of the things that has happened a lot of late is we've been asked by a lot of our clients. Last year was a good year in the markets. I assume most of you that are here are somewhat following the markets, and global equity markets did really well last year. So one of the key questions we're asked quite a bit is, with what we had last year, should we expect the same this year? Should we expect a pullback, or at least can we expect some sort of stability? So rather than come out and answer that ourselves, we said, why don't we bring Andy out and have Andy come and speak to you today and bring some of his perspective. So who Andy is, Andy MacLean, he's Chief Strategist for Raymond James Canada. He's responsible basically at Raymond James for the entire equity research team in Canada. He's also responsible for the longer-term strategic outlook for markets and equities in particular. He's got over 20 years of experience in the business, and you might recognize him as he is a guest on BNN. And we are very appreciative, Andy, of you coming down today from Toronto to share with us some of your perspectives. So with that, thank you, and I'll give you the floor.
Okay, great. Thank you. So to answer the question that was proposed, we are expecting a fairly good year this year, although not quite as good as last year. Last year we had in excess of 20% returns. This year we're looking for a little bit less. And that'll come from two sources. Number one, earnings growth. So we're looking for sort of high single digits, low double digit earnings growth, and some multiple expansion on the market. Basically, we're expecting for the price-earnings ratio on the market as a whole to go up. So with those two factors in mind, what we're expecting is sort of mid-tier type returns this year. Of course, it'll be higher for certain sectors and lower for other sectors, and I'll get into that in a bit of detail later on. But what I'm going to go through today, I'm going to talk about our asset allocation for the firm and sort of what we recommend for the average sort of client in this environment. I'm going to discuss the prospect for a correction. We had a bit of a pullback in the market a couple of weeks ago. I'll just talk about if that will continue or any other risk that might happen later on down the road. And then basically I'm going to justify our asset allocation. That'll be the bulk of my talk. And then I'm going to leave you with some ideas, some trends and that I think that will work out for the next several quarters. So our asset allocation is fairly aggressive at this stage of the cycle. An awful lot of pie charts down here. They're with respect to individual risk classifications, but on average, what we're recommending now for your typical sort of investor is a fairly high allocation towards equities right now. That would be about 65% of your portfolio in equities, about 30% in bonds, and about 5% in cash. Of course, your individual risk tolerances might require that you have a little bit more equity, a little bit less equity. But basically, this is about as aggressive as we can get at any point in the cycle. So we think that the environment right now is the most conducive towards investing in equities. We favor equities over corporate bonds right now. We favor corporate bonds over government bonds, and we favor government bonds over cash. Basically, in this environment, we have, just as we have a maximum allocation towards equities, we have a minimum allocation towards bonds. This is not a very good environment for bonds right now. The shorter the maturity, obviously, the less the yield that bonds deliver. When you take inflation into account and where interest rates are right now, basically cash and short-term bonds give you a negative real return. So we're trying to shy away from those. We favor corporate bonds over government bonds because they give you a bit more of a yield pickup. And of course, we favor equities over bonds right now. In terms of equities, we favor cyclicals over defensives. At this stage of the cycle, cyclicals are the ones that work best. And what do I mean by cyclicals? I'm talking about technology stocks, I'm talking about industrials, and I'm talking about consumer plays. This stage of the market works best for those. In terms of our geographic allocation, our favorite market right now is the US, followed by Europe and then Canada. Canada we're not as positive on right now because half the Canadian market is allocated towards energy and material stocks, sort of mining type companies, that sort of thing. And we're not as positive on those two sectors, so that makes us not as positive on Canada right now. We think that we have more opportunities in the States and in Europe, and especially in the US. There's a lot to choose from as far as cyclicals are concerned, especially in the technology and industrial sectors. And on top of that, you get the added kick of a strong U.S. dollar, and we expect the U.S. dollar to remain strong for the year. So the U.S. is our preferred market. Our second market after that is Europe, followed by Canada. And then a distant fourth would be the emerging markets that we're not really recommending right now. And that's a little bit different from past cycles because the emerging markets historically have led any rebound in the global economy, but that's not going on this time. And I'll get into that in a little bit of detail later on. So by any measure, this rally is getting a little extended. It basically started in March of 2009. It's been going on for the better part of 4 or 5 years now. There have been some interruptions along the way, some mild pullbacks, sort of 10% here, 5% there. But all in all, the rally is getting a little extended. So it's vulnerable to a correction, in my opinion. But that would just be a minor correction of short duration. And we had one about a month ago stemming from another emerging market currency crisis. It got people thinking back to 1997 when we had a full-blown correction coming out of the emerging markets. If you were paying attention to the markets back then, there was the Asian crisis in 97 that caused global markets to pull back about 20-25% over a fairly short period of time. It all sort of started in Thailand, if you can believe it, and then spread out from there through the rest of Asia, into Latin America, into Russia, and dragged all sorts of markets down. We don't think that that's going to happen this time, because the global currency markets and the balance of payment issues within the emerging market economies are very different right now. They have much higher reserves than they did. They have lower debt positions. They tend to hedge their debt, and they have floating currencies right now. So we don't think that there's going to be a massive problem caused by the emerging markets this time around. And that volatility that we saw, that little bit of a pullback that we saw a few weeks ago, we think has been largely contained. The other issue out there right now is China and the prospect for a hard landing or a more severe slowdown in that economy than people are expecting. The Chinese economy right now is transitioning. It's going more from an industrial manufacturing economy, and they're trying to position it more as a consumption-driven economy. Right now, about half of Chinese growth comes from industrial production. That's much higher than a developed market economy, and only about a third of it comes from consumption. What the Chinese authorities want to do to try and make their growth profile more stable is to make it more of a consumption-oriented economy. Canada, the US, we have 60 to 70% of our growth coming from consumption. In China, it's only about 30%. So they want to change their economy to make it a little bit more like ours. Lower growth rate, of course, but much more stable growth. That transition period, though, between now and when that ultimately happens, can be a little bit of a rocky period. And what the Chinese have done over the past several years is built their debt levels up to quite high levels. So that could pose a bit of a problem for global markets because the Chinese economy is such a big part of the global economy right now. If China does slow down too much, then that would have an impact not only on the Canadian market, European market, and US markets. So that's something that we're watching. We don't think that that will happen, that they'll have too severe a slowdown. Because last year when growth slowed down a little bit too much in China, they started adding stimulus to the economy to bring the growth rate back up. So right now, Chinese growth is around 7.5% to 8%, and it doesn't look like the Chinese authorities will let growth get below 7%. So we're not too worried about what's going on in China right now. And even though that private debt levels are high, an awful lot, when you dig into it, you see that an awful lot of that debt is actually owned by the Chinese government. So we don't think that the risk of increased bankruptcies in China would produce a sort of cataclysmic event in that economy, causing bank failures because the government would step in to try and float the banks. So we don't see an awful lot of risk in China at this stage. So what are the key drivers for a market? Initially, when you come out of a downturn, it's driven by three things, I think. First stage is an earnings recovery. We sort of saw that from March of 2009 until late 2010. Then the next stage is multiple expansion, so people are paying more for the growth that they're seeing. And then the final stage is a transition to quality. In my opinion, we're right in the multiple expansion period, sort of in the sweet spot for equity investing at this stage. We've been there for a little over a year and a half, and we think it will continue through this year. We think that it's driven by accommodative monetary policy, so very low interest rates, not only in Canada and the States, but pretty well around the world. That's a key driver. What we're getting into now is global growth synchronization, where all major regions of the world are beginning to grow at the same time. That's something that we haven't seen in about 4 or 5 years, and overall profitability is still strong. So that's why we think we're still in that second phase for the equity markets. So what would cause us to change our view? Number one would be if interest rates started going back up. They're very low right now, but if they start heading significantly higher, that would cause us to change our view considerably, or if valuations move to extreme levels. So what would we do then? What we would do is change our asset allocation. We would bring down the equity weighting that we have in it and bring up the bond weighting at that time. So we would transition as these events look to happen sooner rather than later to a much more conservative outlook as far as the markets are concerned. We don't think that's going to happen until much later, so that's why we're still quite aggressive. But as the situation changes, then we'll get much more conservative in terms of our asset allocation. So monetary environment, extremely accommodative right now. As I said before, not only in Canada, the States, Europe, Japan, just about every major region of the world has what are referred to as negative real interest rates. So when you look at the sort of interest rates that are out there and you take the rate of inflation away, the result is negative interest rates. So basically it's an environment of free money in real terms. It has been like this for quite a while and should remain that way for a couple of more years. A little less so in Canada than some other markets, but the Japanese are still getting very aggressive in lowering interest rates. The Americans really haven't backed off. The Europeans might even get more aggressive. So we're in a unprecedented level, really, as far as accommodative monetary policy is concerned. And this tends to be, of course, not only good for the economy, but also good for the equity markets. Another way to measure the monetary environment is by excess liquidity. And what I mean there is the excess of money supply growth over what's going on in the economy, over nominal GDP. When you're in an environment where there's more money sloshing around than the economy can absorb, it tends to be inflationary. So sometimes it can be inflationary in the real economy, drive up the price of goods. Other times it'll be inflationary in the financial economy, which it is right now. It tends to drive up asset values. And that's by design. It's designed to drive up housing values, and it's designed to drive up the equity market. Why is the government doing this? To try and spark consumption. Because there is a wealth effect from rising house prices and rising equities that it does promote spending. So that's another tool that they've been using over the past 4 or 5 years to get the economy growing at a much higher rate. Yield curve, that's the difference between very short-term interest rates and longer-term interest rates. Usually when the difference between those sorts of bonds, short-term bonds and long-term bonds is great, the economy is in an expansion mode where we are right now. It's when it inverts, when short-term interest rates get higher than longer-term interest rates, that you're usually in an environment where a recession is about to begin, and we're a long ways away from that happening. So that's a very strong indicator of what's going on in the monetary environment. Credit spreads continue to contract. Basically, that's the difference between corporate bonds and government bonds. The less the spread is, usually it's an indication that the economy is strong, that the markets are strong, and spreads continue to contract between corporate bonds and government bonds. And that's usually a very good indicator, not only for the economy as a whole, but also for equities. As I said before, we're into an environment now where most major regions of the world are beginning to grow at the same time. Basically, since the end of the financial crisis in 2008, we sort of sputtered from one minor crisis to another. We had budgetary problems in the States. We had a banking and sovereign debt crisis in Europe. We had fears of a hard landing in China. All these concerns have sort of gone to the wayside. And now we're starting to see growth in all these regions. US is growing about 2.5%. Europe has exited their recession. And as I said, Chinese growth is around 7.5%. We really haven't seen these conditions at place in the global economy since about 2006, where all the major regions are growing at the same time. So what we tend to track are something called PMIs, that's Purchasing Managers Index. That tends to give us a good idea of what's in store for the economy a little bit later on down the road. When purchasing managers' decisions to buy more machinery, to invest in property, plant, and equipment is strong, that usually bodes well for not only the economy, employment, but also for the equity markets. And we're in an environment right now where we're seeing an awful lot of reinvestment into the economy. So that's a very, very strong indicator. Leading indicators that we track are also pointing in the right direction. Most of them, this is for the US, but also most other economies have not only recovered from the Great Recession, or well on the way to recovering from the Great Recession, but you can really see an improvement as far as employment is concerned, as far as asset prices, all those sorts of indicators that we track, and that's being fueled mostly by record low interest rates. The other key driver is profitability. Now, margins have pulled back a little bit from record high levels, but they're still quite high. We think that they can remain at elevated levels for the next couple of years, driven by two factors. Number one is low interest rates, and number two is still fairly high unemployment. About 2/3 of costs for corporations come from the sort of the wage side of things. With unemployment where it is, we're not likely to see any wage pressure, any increase in costs from employment until we get an unemployment level about 200 basis points below where we are right now. So if we take the US, for example, it's just below 6%. The unemployment rate would have to get down to around 4% and stay there for an extended period of time before you'd really start seeing cost pressures in terms of wages picking up that would negatively impact profitability. At the same time, interest rates would have to back up quite a bit too, or we'd have to be in an environment of much higher interest rates before that would start weighing on profitability as well. So the basic picture is that for the next 2 years, we're still going to have a very good environment as far as profitability is concerned. So what would cause us to change our view? Number one would be if we have higher interest rates. Right now they're at historically low levels. Of course, they're not going to go much lower than they are right now, but we don't think that things are going to turn around and head higher anytime soon. Basically, the Federal Reserve Board in the States, the European Central Bank, Bank of Japan, Bank of England, have all pretty well said that they won't even contemplate raising interest rates until we get into late 2015. So that's almost 2 years away. And even if they start increasing them, they'll only be marginal increases. So we're not going to have that heavy headwind that comes from higher interest rates for an extended period of time, for at least 2 years. Most central banks are still in easing mode, and they're not even close to thinking about tightening right now. So we're going to be left in an environment for an extended period of time of very low interest rates. Not good for bond investing, but very good for investing in equities. The other factor that would cause us to change our view would be if valuations start to move to extreme levels. Focus on this chart. This is a price-earnings ratio chart for the market as a whole. You can see we're sort of in the midpoint of the longer-term range right now. Stocks aren't too cheap. They're not too expensive. We've come up an awful lot since the lows. So remember before when I was talking about multiple expansion? This is actually multiple expansion going on, and we think that it can head a bit higher before we get into an environment where valuations become stretched. At that time, then risk would obviously start building up in the market. We don't think we're quite at that point yet. We think they would have to go a lot higher before people would start getting very concerned about valuations. And so we think we have quite a bit more to run. And what will cause multiples to expand, it'll mostly be the accommodative monetary environment that we've seen over the past several years. There tends to be a fairly high correlation between accommodative monetary policy and multiple expansion. So since we're not at the point where valuations have moved to extreme levels, we're not about to change our views and rein in our horns anytime soon. You can see the record was set sort of back around 1999, 2000, when we got into the tech mania. And we're a long way away from that sort of environment building up. So in terms of positioning and themes, as far as the equity market is concerned, we're overweight cyclicals, so that means industrials, sort of companies that make machinery, technology, you all know what that is, and then consumer cyclicals. Consumer cyclicals tend to be things like autos and housing stocks, those sorts of things. They are the sectors that perform best in this sort of macroeconomic environment. We've been recommending these sectors for a while, and we continue to recommend them. The valuations in this group have not become extended at all. There's still very good earnings growth, so we think this is where you should be focused as far as your equity portfolio is concerned. We also like financials. This environment is very good for financials, low interest rates, steep yield curve. We prefer insurance companies to banks right now, although this week we saw fairly good earnings coming in on the Canadian banks. We continue to see dividend growth, fairly strong profitability, so that's good. But what we like about the insurance stocks is that the bond market is acting a little bit better. What had really negatively impacted the insurance companies since the beginning of the financial crisis was a big disconnect between their assets and liabilities. So the risks between insurance companies' assets and liabilities have started to stabilize a little bit, so the insurance companies look a little bit better in this environment. And I'm referring mostly to life insurance companies. We're neutral on energy and materials right now. They tend to perform better later in a cycle. As the cycle becomes very extended and inflation begins to kick in, then energy and material companies tend to do better. And we think that we're a couple years away from that happening. In this environment, the only thing that you can say about the energy and material stocks is that they're very, very cheap. They're trading pretty well at recessionary trough levels. So if you're very patient and you don't mind some volatility in the market, then you could consider those sectors, but I think you'd have a better entry point a year or two down the road. And we're underweight utilities and telecom in this environment. They tend to be very highly correlated to what goes on with interest rates. If we do see any sort of uptick in interest rates, that will be negative for utilities and telecom. And what I mean by the interest rates that impact them are more longer-term bonds rather than short-term bonds. And we are seeing a little bit of an increase in interest rates on long-term bonds, just not on short-term bonds. And then consumer staples and healthcare. Remember earlier in my talk when I was talking about a transition to quality? That's when those companies would start acting better. Consumer staples and healthcare, they tend to have very, very stable and visible earnings profiles, and they're the types of stocks that investors gravitate towards when you get later in the cycle and people become a little bit worried about valuations and profitability and that sort of thing. They'll transition to those companies. But in this environment, we're still very much focused on industrials, technology, and consumer cyclicals. The themes that we think will play out for this year and into next year will be something on a global basis that we refer to as an asset allocation shift. Interest rates are just about as low as they can go across the globe. And although we're not expecting them to increase dramatically anytime soon, the next move for interest rates will be higher. Sort of 2 years, 3 years down the road, we'll be left with a much higher interest rate environment. The only reason to really hang on to bonds now would be is if you expect interest rates to go much lower. Of course, that drives up bond prices and that would make bond investing a good idea. But it's not really possible for interest rates to go any lower than they're at right now. So we don't really see a compelling reason to own bonds. And this is fairly obvious to everyone. So what we think will happen is that this is going to promote an asset allocation shift out of bonds and into equities. The number one performing asset class since about 1982 up until about 2012, and just last year, were bonds. They weren't equities, they were bonds. You came from an environment of very, very high interest rates all the way down to almost nothing. And that was a great environment to invest in bonds. But we think from a very long-term perspective that that environment is over. And that's fairly obvious to an awful lot of investors out there. So what we think that we'll do is promote a shift out of bonds and into equities. And we think that we're in the early stages of that. And that will drive equity returns just from a simple supply-demand perspective, we think, over the next couple of years. The second factor, let me just get into that. The second factor is rising corporate spending. Basically, the capital stock, and what I mean by that is property, plant, machinery, all that sort of stuff, is about the oldest it's been in 40 years. So it has to be replaced. The truck fleet, for example, in the States, is usually around 6 or 7 years old. Right now, it's around 11 or 12 years old. So there's a lot of stuff out there that has to be replaced. So why hasn't it been replaced? Well, we had a financial crisis in 2008. That kept an awful lot of companies on the sidelines, not wanting to reinvest into their business until they saw what the global environment is like. Now that it's improved a bit, their purse strings are starting to loosen. U.S. companies are sitting on over $1 trillion in cash. So it's our expectation that this year, that money will start coming back into the economy. They'll start spending on equipment, on technology, because if they don't, then their long-term profitability will be eroded. So what we're seeing right now, the sort of short-term catalyst that we think will drive that spending is the fact that both consumer and business sentiment is picking up quite a bit. There was an awful lot of volatility in these measures since around 2008 during the financial crisis. But now that the economy has started coming back, that employment is improving, that wages are just starting to go up a little bit, that sentiment overall is improving, and we think that that will help companies loosen their purse strings and start spending. $1 trillion in spending will go a long way to drive growth. And that's just one economy, that's just the US. Similar thing in Europe and also in Asia. So you'll see a lot more spending. So the best way to play that theme would be in technology. Technology, number one, and number two would be in industrials. We think that the strength in the US dollar is going to continue. That's going to be driven by a couple of things. Number one is that the US, as far as a global growth trajectory is concerned, is further along than most other economies. Europe is just getting out of a recession. Asian growth is actually slowing down a little bit, but the US is quite strong. Naturally, that promotes the buying of US goods, and just from a flow of funds perspective, you'll see more money flowing into the US. That will help drive up their currency. That tends to be very good for cyclicals and equity markets in general, and tends to be bad for commodities. And that's one of the reasons why we're not positive on material stocks or energy stocks right now, because of the headwind from a rising US dollar. We think that cyclicals, sort of the industrials, technology, consumer type stocks, will continue to outperform. They're driven by accommodative monetary policy, global growth synchronization. And so these two factors should lead to continued outperformance in those sectors. And this is interesting, as I said before, that we expect the developed markets to continue to outperform the emerging markets. The emerging markets right now are suffering from rising debt levels, rising inflation, balance of payments problems. And there's been an erosion as far as profitability and productivity is concerned. Usually at this stage of the cycle, those markets are the ones that are performing quite strong. We think that there's an adjustment process underway, that there will be a good opportunity to invest in the emerging markets, but we think that'll be more of a story for 2015 rather than 2014. The developed markets are the way to go right now. And as I said, our preferred market is the US, followed by Europe and then Canada. So that's pretty well it as far as our outlook is concerned for the markets as a whole. If you guys have any questions, we'll open it up now and we can discuss them.
Crimea?
It's difficult to factor those sorts of things into sort of a overarching macro outlook. Usually what happens when you get into a situation like these sort of geopolitical events is that you'll get a short period of volatility and then markets will typically recover fairly quickly. Even from major wars like the Gulf War I, you would get a recovery within about sort of 3 to 4 months. And we don't think that this situation will be anywhere near as bad as that. Already it looks like the Russians have backed off a little bit. So we don't think that this one is going to spill over.
Could you ever see a situation where the equity market became so volatile that people started to flock towards the cash, the bonds, and then have interest rates start to increase?
Not usually. What happens is typically if you get into a very volatile period in the equity markets, and I'll use 1997 for an example. People got very worried about equities driven all by the Asian currency crisis. And what they then went into was the US dollar, basically US government bonds. They're sort of the global bastion of safety. So you will get that bond market rally when you get an extremely volatile period in with equities. But what tends to happen then is that the government will intervene, and the Fed did intervene at that time. And I could cite some other examples. But what they'll do is that they will drive interest rates down because they don't want the sort of shortage of liquidity to basically start driving up interest rates. They try and counteract that by driving interest rates down. And the Fed did that they did it following 9/11, they did it in 97, they did it during the financial crisis in 08. Some governments are still doing it, the Japanese are still doing it, and the Europeans might do it. So the natural tendency for the economy, if left to its own devices, would be for rising interest rates. But the government will come in and flood, or the central bank will come in and tend to flood the market with liquidity to drive interest rates down. So that's why you tend to see lower interest rates in that sort of environment. But whenever you do get into those volatile periods, you do see people transitioning out of equities, especially the risky equities, and into bonds. So you get the equity market down, bond market up. And that's part of the reason why we have an asset allocation. And say, well, we're very positive on equities right now. Why have any bonds in your portfolio? Well, part of the reason is that when you get into these volatile periods, you do see transitions out of equities and into bonds, and that sort of mitigates the risk of your entire portfolio a bit.
You talked about financials, Canada versus U.S. You talked about Canadian banks.
Yeah.
Good earnings. Are you leaning more towards U.S. banks or Canadian or
I think
financials, in which way?
I think more Canadian banks right now, just for the stability of their earnings profiles. But more importantly is that you see good dividend growth coming out of the Canadian banks. And for Canadian investors, Canadian domiciled investors, that's actually quite a bit of a pickup to have good dividend increases following up on top of the half-decent earnings growth. In the U.S., you did have a big opportunity, obviously, after 2008, when essentially the entire banking industry in the States was destroyed, and you had prices down 90% in some cases. There was a good buying opportunity if you're willing to take on that risk. Of course, that's dissipated a bit. The banking stocks in the States have recovered quite a bit. There are some situations, though, I think in Europe, where you have some opportunities that are similar to what you had in the States in around 2009. So the reason why I would invest in some of those opportunities is because when you have the backing of a central bank, essentially your banks can no longer fail. Because if the central bank is backing your financial system, then they have unlimited resources. They can actually just print money all day long, and your banks are not going to go bankrupt, right? So that's a situation you had in the States, because if the Fed didn't do that, the entire banking system in the States would have gone bankrupt. There simply were not enough assets there. The same with Europe. They just went through a banking crisis, but the European Central Bank has committed to back the banking system there. So there are some opportunities, and the one that we're recommending right now is Banque Nationale Paris, so BNP out of France. I think is a half-decent opportunity. But there are a number of Italian banks that look okay, even some Spanish banks that don't look too bad, like Santander, but not the smaller Spanish banks. So there are some opportunities there, and I don't think the risk is that great.
You talked a little bit about multiple expansion.
Yeah.
And I know we've seen a lot of that in the last year. So can you just tell us why you think, given the optimism is so high right now, why do you think that'll continue to be the case?
In my opinion, it's driven by sort of what you're seeing as far as an expanding global economy is concerned. You're starting to see still a very accommodative monetary policy. Historically, anyway, when you see both those factors in place, they tend to line up very well with multiple expansion. And I would argue that an accommodative monetary environment and an expanding global economy drive multiple expansion. So we sort of went off the bottom where earnings were at about 10 times. The PE was at about 10 times. We've moved up to about 20 times. That's sort of in the midpoint of the longer term range. But it doesn't usually peak out until you get up 25, 27 times. Then you start to have some concerns about valuation. And usually what puts the brakes on the whole thing is the central bank turning to more restrictive monetary policy. Basically, by that, the monetary authorities are trying to cool the economy. They try to cool the economy, they cool the stock market at the same time. I think they're a couple of years away from doing that. So that's why I think multiples will work higher.
Is the Federal Reserve what prints the money in the States?
Yep. Yep.
So my understanding is, first of all, there's never been more bond issues and debt issued from the U.S. because they're running at deficits that they've never seen before.
Mm-hmm.
And my understanding is that China, who used to be a primary buyer of this, has pulled back from doing so. So the Fed is left to basically issue, I don't know where the bonds are issued from, but the Fed is the one that's doing most of the buying with the money it's printing.
Yes.
How is that not inflationary?
It is, in a sense. And when I was talking about excess liquidity, that's measured a little bit different, in a different way. That's the excess of money supply growth over what the economy actually needs. That is inflationary. And when people talk about inflation, having too much money, that's sort of what they're referring to. And that it will cause, the price of cars to go up and price of machinery to go up. But what's happening this time around, and this has actually happened before, is that it's driving up asset prices. So you're seeing the inflation not in the real economy, you're actually seeing the inflation in the financial economy. You're seeing it in the stock market and you're seeing it in the housing market. They're doing that on purpose, especially in the States. They're trying to drive up housing prices so that the housing market in the States can continue to recover, because it is a pretty big employer and it is a pretty big chunk of the US economy. Plus it also impacts people's consumption behavior. So they are trying to generate that inflation, and that inflation is going on. Housing prices have recovered, I think, about 60 or 70% of what they lost during the financial crisis. So there is that inflation, and there's also that inflation in the stock market too. We've recovered about 100% of what we lost during the financial crisis. So there is inflation going on. The reason why you're not seeing that inflation show up in the real economy, and there are a lot of debates about this, but it probably relates to sort of an overall fall in aggregate demand and sort of the amount of goods and services that are bought in the economy as a whole. And the reason for that, and we're likely going to encounter more and more of this, is basically from demographics. Population is aging and spending tends to go down. Japan is well on the route of this. They've been on that trajectory for the better part of 2 decades. We're just beginning to get into it. Europe is a little bit ahead of us. So all this will have a little bit of an impact. And that's one of the reasons why all this money printing that's been going on hasn't really caused that much inflation in the real economy. There are some factors that have offset it a bit. But yeah, you're right. Actually, the biggest buyer of U.S. debt right now is the U.S. government. And then the second biggest buyer is China. And China has backed off a little bit, but we're talking just very small moves. What the Chinese have done is up their holdings of gold a little bit, backed off the U.S. dollar, diversified a little bit into some other currencies. But it's
China's still kicking out a huge surplus where the U.S. is at a terrible deficit.
And then there's another debate on how much that really matters. Your debt levels, your deficit levels. Just if you examine your own personal finances, you go, well, this is a disastrous setting. How can a country behave like that? Well, the U.S. had much, much higher debt and deficit levels at the end of World War II than they do right now, by a multiple. It was a multiple higher. And there are three ways to get rid of that. You can inflate your way out of it, you can grow your way out of it, or you do what they're trying to do right now, and that's have an environment of negative real interest rates, because what that does is that lowers the real long-term value of your debt. And that's one of the reasons why they will keep real interest rates negative for as long as they possibly can, because that allows you to raise money essentially at no cost. So you can finance your deficits, it doesn't cost you anything. And as higher interest rate debt rolls over, you replace it with something that doesn't cost you anything. In nominal terms, it looks like it costs you something, but in real terms, it's not costing you anything. And that, you think, okay, well, you're only playing with 1%, maybe 2% a year, but if you do that over an extended period of time, that can really take care of a debt problem. And that's how the U.S. got out of the high debt levels from World War II, is by having negative real interest rates for an extended period of time. The other ways of getting rid of high debt levels is austerity. Well, you just have to ask the Greeks or the Spaniards what they think of that. They don't think very much of it. And then the other way is to try and grow your way out of it. So they're trying a combination of negative real interest rates and a bit of growth to take care of the problem that way. So adding to the debt pile when it doesn't cost you anything is not that damaging long-term to the economy. Until the interest rates go up and they continue to try financing with higher interest rates. See, if they stop trying to finance, then you're okay. You still have very low interest rates sort of embedded in your debt pile. But we'll see what happens later on. Yeah, and there are very long-term issues related to healthcare, aging population, all that sort of stuff. So we'll see. But that's, we're talking 10, 15, 20 years out. Yeah, it could be an issue. So, what are people hoping for then? Well, they're hoping that the much more favorable demographic profile in the emerging markets will help to offset that a little bit from a global perspective, that there will be growth generated. Might not all be here, but there will still be opportunities for us to sell our products into much higher growing markets.
Now that you talk about demographics, what role will immigration in Canada play in the future development of the markets?
I think that will help offset things a bit. Canada, the States, Australia, New Zealand, we have better, or I'd say, I don't know if you want to say better, but we have much higher sort of population plus immigration growth rates than Europe does, let's say Spain or Italy. Those countries are already suffering from the negative impact and Japan too, already suffering from the negative impact of a declining population. Canada will be affected. Like, we won't have the sort of growth that we had from population that we had in the 50s, 60s, and 70s, but it won't be as bad as Italy or Spain, anywhere near what they're likely to experience.
Just to back up one comment, because you've been focusing on how the Americans are dealing with their debt? And I take it Canadians are probably following suit?
In terms of, it depends what kind of debt you're talking about.
Federal
Public debt,
Yes.
our debt levels are much lower than they are in the States.
in terms of percentage or per capita?
Yeah, as a percentage of GDP, let's say. The US is well over 80%. Canada is probably, I think we're the lowest in the G8 right now, by a wide margin. All the austerity that was introduced under the Martin government and Chrétien, I mean, that really has paid dividends, and paid dividends through the financial crisis. Not only were our banks set up well, but the government was set up well from a financial perspective. And we should be producing a surplus, I think, next year, the year after. So we're not in a bad position at all. You can think that less debt is always better, but there's a point at which you don't want to reduce your debt too much. You know.
So it sounds like it's not really an issue, certainly compared to the States.
No. And the U.S. isn't that bad either, because all that you have to do is look at Japan with double the debt levels of anybody else. And if the Japanese economy hasn't been blown completely out of the water, I mean, it had very poor growth profile for an extended period of time, but it didn't collapse, even though it was operating under a tremendous debt burden. I don't think it would happen to the U.S. It certainly wouldn't happen to Canada. What you have to have, though, if you're running high debt levels like that, is you need to have control over your currency. And that was the problem with Greece and with Spain. They didn't have control over their currency. The Germans control the euro. It's not in the periphery economies, and that's why they got into so much trouble. But we control our own currency. The U.S. controls their currency. The Japanese control their currency. So that makes it a lot easier. There is a huge debate going on out there about debt levels and all that. But I think more important from Canada's perspective is productivity growth. We do have a problem here on productivity, and we have had that for quite a while. Manufacturing part of the Canadian economy is always clamoring for a lower dollar, just to give us a bit of an advantage. But you can't do that forever. You can't have a low dollar policy in place to infinity. It just won't work. What they have to do is try and equalize tax policy, just to even it out, I think, a little bit. That would go a long way. But productivity is an issue, longer term, for the Canadian economy.
Do you see any pressure on the Canadian economy from high consumer debt levels or the potential of a housing market correction?
I think that a housing market correction won't happen in isolation. I think you need two things to happen to really make it bad. One would be rising interest rates. And it would have to be for an extended period of time to give people a chance to roll over mortgages at higher levels. And the other would be rising unemployment. Those two things will work magic for a housing correction. So I don't think that it will happen, or a serious correction will not happen without those factors being in place. The other issue is what's going on with the marginal buyer and who is the marginal buyer. If the marginal buyer disappears, let's say the marginal buyer was was outside money, Asian money coming into Vancouver. So you have to consider what goes on in Asia. If Asian growth is slowing down a little bit, then that money's not coming over. And you actually saw that go on in the Vancouver real estate market a little bit. That produced a bit of a pullback. But a more severe correction, I think it has to be as a result of underlying fundamental changes in the economy, basically heading into a recession. That'll do it. And I think we're a couple to a few years away from that happening.
Pardon my naivety, but when you say certain things, the question why screams at me. So a few minutes ago you said there's a point at which you don't want to reduce your debt level too much. Why? Help me to understand that statement.
Because what's going on right now in the global economy, or in more the developed world, is that you have you have a savings glut. You have much too much savings going on in the Canadian economy, in the US economy, in the European economy. If you look at the debt situation as a whole and the amount of money that's being thrown off from these economies. So what that tends to do in the economy then, if you're throwing off too much savings, is drive down real returns in the economy. So you need somebody to actually start spending that money. And if individuals aren't doing it because we're all saving too much, and I mean, I don't mean by, just us people sitting here, I also mean corporations, all that. If not enough money is being spent, then you have a problem in your economy. Then demand is actually ratcheting down. You need somebody to come in there and spend that money. And that's where governments can come in. So it's not always best to have debt levels going down forever. There are points in the cycle where you need that debt, you need that spending to go on, just to soak up all the excess savings. Because if all this excess money is sitting out there, it's just going to drive down growth in the economy. And that was one of the problems that the Japanese had, is that they had tremendous savings from the 50s, 60s, 70s, that as you got into the 90s, then you had a problem. They had way too much money. And there was no way to absorb all the excess. So what they should have done at that time was to even spend more than they were doing, but they didn't do it. So.
With the current energy surplus right now and the rising U.S. dollar, does that mean that the Canadian dollar is probably going to continue to sink?
I think that it could. I think that it could work lower. We have some currency folks at work who look at this in a bit more detail. They think that maybe you could see 3 or 4 pennies lower, maybe a nickel lower, but not an awful lot more than that over the short term. It depends on how the energy situation in North America plays out, how much excess production you get coming out of the States. That'll really determine what goes on. But I think that sort of maybe 3 to 5 cents lower on the Canadian dollar, I think is reasonable. But I don't think that we're going to go back to an environment of a 65-cent dollar, because that was driven by different factors, mostly terrible handling of government finances that was responsible for that primarily. But I think a Canadian dollar sort of in the 85 to 90 region, as long as energy supply stays up where it is right now, I think that's probably the environment that we'll be in. Okay.
For somebody looking to enjoy some of the run-up in the market and equities, but also maybe if there's a pullback looking to protect themselves, what's the most efficient way? Is it through put options? Is it through shorting indexes? What would you recommend?
The most efficient way to do it, in my opinion, is to run a bit of an asset allocation, to have some exposure to bonds. Because if you are worried about that pullback, usually what will happen is that there will be some sort of shock to the market that will drive down equity prices, but that shock to the equity market tends to drive up bond prices. So you're offset, you're immunized a little bit by doing that. I find puts or using derivatives, stuff like that, they tend to be very expensive. So that, for example, if you want to fully hedge a portfolio over, let's say, a decade, or not a decade, a full year, it will cost you 10% the value of that portfolio to hedge it. So if you continuously do that, that's going to chew up an awful lot of the value of your portfolio until that day happens where you need it. So it's an expensive proposition. I think running an asset allocation, having some money in bonds, having a diversified equity portfolio, and just running with it over the course of the cycle is the best way to go. And then as the market gets out of whack, let's say you do have a pullback in equities, bond prices move up, then you can sell off a little bit of the bonds and buy some of the equities. So what you'd be doing is you'd be selling something expensive and buying something cheap. And then, as I said before, what would cause us to change our sort of view as far as an asset allocation is concerned would be when valuations get stretched. Then we would look at transitioning to a more conservative asset allocation mix. That's sort of the same thing as saying we're gonna sell expensive equities and buy cheap bonds at that point. So that's how we would tend to sort of try and hedge ourselves over the course of a cycle. But put options or derivatives, stuff like that, it tends to be very, very expensive.
Now, do we have extreme pricing in housing now?
I would say there's all sorts of different ways to measure it. You measure it relative to what rents are, what income levels are, where interest rates are. I would say by every measure, yeah, we have an expensive real estate market. And independently, if you compare it to international markets, it's expensive. And the economist has said we have an expensive real estate market. The IMF has said it. The ratings agencies that cover the banks have told them to be careful of their mortgage lending. Yeah, I'd say across the board we do have an expensive housing market. There will be a correction.
Does that fit one of the two criteria for being concerned?
Not in the way that the Canadian housing market is set up and the exposure that the banks have to them. I think it is a little bit of a concern for longer-term consumption in the Canadian economy. If you got a severe housing pullback, you would have quite a nasty recession. So let's say when the environment is set up to have that housing correction, so we get into an environment of rising interest rates, and let's say unemployment is going up, then the next recession in the Canadian economy is going to be much worse than we're used to for a normal recession. Because housing will correct that much more, and then the knock-on effects will be felt in consumption. Consumption will go down that much lower. So yes, it'll be a problem for the Canadian economy, but the key thing that we'll be watching then is what's going on with interest rates, and that's sort of one of the factors that we're paying attention to.
Thank you for bringing interest rates back into the conversation, because earlier in your presentation, and I don't remember the exact context, but you said unless interest rates become significantly higher. Would you share with me what your definition of significantly higher is?
Usually over the course of a cycle, okay, and there's many different interest rates out there. There's longer-term bonds, and then there's very short-term interest rates that are set by government policy. So I'm talking mostly about the short-term interest rates that are set by, that are a function of government policy and where they want interest rate levels to be. So over the course of a cycle, in long-term cycles and many cycles, usually what you have is a real cost of capital over time of about 2%. You usually run a rate of inflation of about 2%. So that means that your short-term interest rates over time, averaged out, tend to be about 4%. When you get into an environment where interest rates are much above that, above 4%, then there's a natural break on the economy, that the cost of money is starting to get expensive in real terms. So when interest rates would go up, let's say much above 4%, short-term interest rates, sort of less than a year, sort of 1 to 3 months, much above 4%, then that's a bit of a negative sign. If you think back to 1979, 1980, 81, they were up around 19%, 18% for a short period of time. So yeah, much above 4% into the 5% territory, then you really have to start to begin to pay attention to it. So those are the sorts of levels. And considering where we are right now, way below 1%, we have an awful lot of room that we can play with.
Do we have reasonable transparency and understanding of the new products that are out there with regards to investments such as hedging, derivatives, that sort of thing, so that what happened in 2008 doesn't happen again?
Well, okay. The regulators are, much like generals, always fighting the last war, right? So all the policies that are putting in place right now are designed to try and prevent the same sort of thing from happening. Of course, the next crisis will be sparked by something completely different. But the basic gist of all the regulatory changes are to try and get the banks to recognize and to take onto their balance sheets all the risk in the products that they create, on the view that they'd be the best ones to police it. I believe that view is correct. But what the American banks did leading up to the financial crisis was, through something called securitization, they basically took all this risk and sold it to other people. They're not as able now to sell off that risk. They have to keep it in-house. So yes, they've done a bit better job on that front. But does that prevent the next crisis? Probably not. Next crisis will come from something else.
So they sold off that risk. Why was there such a rush to protect the banks? Why was there such a concern that they were going to fail?
They didn't sell it all off. They sold a lot of it off. But what happens is when you create the product, it sort of has to sit on your shelf for a little while before you can get somebody to buy it. So when the financial crisis came, they were sort of stuck with their hand in the cookie jar, right? They all had a lot of this product sitting on their balance sheets before they were able to ship it out the door. And banks operate, the way that a bank operates, it's really with very little capital relative to the amount of its liabilities. So that if it's sitting on a product that is going down significantly in value, then that has a disproportionate negative impact. There's sort of a multiplier effect on what it does to a bank's capital position. And it just so happened during the financial crisis that they were sitting on enough of this stuff to basically wipe out their capital. So that's why they had to come to their rescue, because the banks were essentially insolvent at that time. So that's why they had to do it.
So the Bitcoin's not taking over the world?
The only thing that I can say about Bitcoins is that you can have some degree of confidence over how much will be printed. There is a schedule on how much will exist. With paper money, you don't know that. That's why gold is still where it is. I mean, the real inherent value of gold is pretty well zero. It's just a rock, right? But it does have some value as a store of value, and protecting yourself against a government that prints money excessively. So, but we'll see what happens. The reputation of Bitcoins hasn't been helped over the past couple of weeks.